Welcome to the Mid-Market Edge podcast, where we uncover operational insights for private equity-backed portfolio companies. I'm your host, Kevin Bonfield, and over the last 30 years, I've had the privilege of working with fast-growing entrepreneurial teams, helping them scale, tackle challenges, and seize new opportunities. On this show, we'll talk to industry experts and seasoned leaders who will share practical strategies to drive growth, boost efficiency, and create value in the mid-market. Get ready for an insightful, engaging conversation that dives deep into the real-world issues facing your business. Hello, welcome to the Mid-Market Edge. I want to welcome today Patrick O'Connell to the podcast. Welcome, Patrick.
Thanks for having me. Happy to be here.
Awesome. And you've got a great background. I don't get to see this very often. The entrepreneurial gene coupled with an accounting kind of gene as well. So how did tell me more about O'Connell Advisory and then how you started out as your own business owner.
Yeah, and really appreciate you being here. Happy to contribute to your audience. So I spent the early part of my career in traditional transaction advisory firms, but I was always an entrepreneur by nature. My first business was when I was 8 years old, and I've had multiple businesses. So coming from the lens of, a traditional accounting corporate career, I always had that itch to help business owners and entrepreneurs buy and sell companies. I just happened to fall into middle market M&A. So that is really the thesis of what created OAG. We work with exceptional American and international entrepreneurs, business buyers, private equity, independent sponsors in this lower middle market acquisition world. We primarily serve as the QV provider, but I like to think of us as much more than just that.
So what is it about when you decided to move your career forward and go from being an advisor with another firm and then starting your own firm? What was the trigger for that?
Yeah, so when I was in a traditional transaction advisory firm, I had exposure into working with some of these smaller business owners. Think EBITDAs of 1 million or 2 million. They just happen to be working with a larger accounting firm. And it's just a different type of transaction, one that you got to roll up your sleeves for. There might not be sophisticated teams. And I sort of fell in love with that much more than larger scale transactions. I felt that the entrepreneurs, the owners really cared about their businesses and the buyers wanted to do right by them. It was maybe small private equity companies, newer funds, et cetera. And it was just a more exciting transaction.
So that combination of the logic of an Excel spreadsheet and then also the EQ of working with sellers who are going through this for the first time, that sounds like it was important to you as a place that you wanted to spend your time.
That's right. And what started as a solo shop as me as the lead practitioner has quickly grown to several full-time employees. To date, we work financial, transactional, tax, and valuation advisory for a lot of these entrepreneurs and investors.
So let's dive into the QOV piece because that's where you spend the majority of your time, I think. So as an entrepreneur is getting ready to move into this process of selling their business, they've obviously put their blood, sweat, and tears into it, and you're one of the first people they start to engage with as they begin that journey towards the sale. So how does that start? What's the first conversation look like?
Yeah, so the first conversation is to understand, where the sellers are at in the process. Typically, they'll be represented by a banker or advisor, and then it's understanding, let's get to the granular components of the valuation of the business and really prepare these sellers for the buyer team and the line of questioning they're going to use throughout this process. A lot of these entrepreneurs are great at running their businesses, but they haven't conducted transactions. So the line of questioning and the way the minutia of some of these deals is very much you have to learn it before a live deal is going on.
Yeah, no, absolutely. And for some of them they will run their own Q of E before they get into the process, and for others they will do Q of E on the sell on the buy side as part of it. So you'd probably see both of those angles.
That's right. Yeah, I mean, we've worked with hundreds of buyers and sellers. Typically, we'll do about 70% buy side Q of E's, but we've done dozens of seller Q of E's. And it's just a different type of project if you're
Mm.
doing a seller buy side.
But the issue is still the same, right? Which is you've got an owner who is completely invested in their business. They think that it's worth whatever they think that it's worth based on the financials that they have, but they've typically run their business based on minimizing the tax payments they have rather than maybe presenting it in the most favorable light for a buyer. So how do you have those difficult conversations with them when there's that disconnect?
Yeah, and that's a challenge. I like to use the word, let's try to make these deals as frictionless as possible. There's a lot of friction in deals. These are potential retirement plans for some of these wonderful sellers. So it's very important to maximize the value of their sale. At the same time, in order to transact, a buyer has to have a reasonable valuation and pay a fair purchase price.
Mhm.
Um, so to answer your question is how do we get there? It's through education and putting together a packet that's defendable at the accounting level and supported by the true business earnings. Um, so that's typically where we start.
Yeah. And what have you seen where you've got a large disconnect between what the seller thinks it's worth and the buyer thinks that it's worth?
Yeah, so this is I often will say it's the country club dilemma, which is some sellers may have friends who've sold their businesses, in prior years, and they have a number in mind of what their business is worth based on their peers or, maybe competitors, but it doesn't actually equate to the value of their business. So it's just educating them on just because they have a number in mind, it might not be the reality of what a buyer today is willing to pay for it.
Yeah. I see that I think in two different dimensions. One is do we agree on what the EBITDA of the company is? And sometimes there's things like percentage of completion accounting and all of the add backs that change that calculus. I mean, I'm sure that you see that on a regular basis.
That's right. And depending on, without, I'll spare your audience of the technicals of around GAAP accrual versus cash basis accounting, but
Mhm.
effectively, any valuation for any business needs to be supported by generally accepted accounting principles, and it's conducted based on a defendable EBITDA number.
Mhm.
What that number is hopefully the end goal of this project.
Right. And then the other piece of it, which I tend to see more on the operational side is what's the multiple that's going to get paid, and that is partly based on the size of the business, but it's also subject to so many other different things that play into what a buyer is willing to pay.
That's right. Things like the economy, what does the market, the M&A market in general look like on any given quarter or year? If we go back to COVID days or 2021, valuations were significantly higher than they are today. Um, that's for a number of reasons. Um, Whether or not we get back to those levels, I certainly don't have a crystal ball. I wish I did. But I think if sellers can align themselves with a proper deal team, get to the crux of what is their EBITDA, put together a fair valuation, they do have the ability to still transact in this market.
Mhm. Yeah. No, the valuations are definitely moving around, and I've seen that with similarly sized companies where one has a growth path that looks like it's going up and to the right, and the other one looks fairly flat, and the multiple difference can be fairly significant. If one is more of a platform than an add-on, again, it just plays into a massive difference in valuation.
That's right. And it depends on the type of buyer. your banker or representative is trying to solicit? Is it going to be a strategic buyer? Is it going to be approached by a private equity fund with a different strategy? Some strategics may want to pay a higher valuation just because they have a clear playbook versus a standalone purchase. There's so many ways to transact a business. It's important the sellers and the owners and these entrepreneurs just align themselves with a good deal team to be
Right.
able to transact.
Right. So when you've seen that, and there's a let's talk some stories that you've gone through. But when you've seen a massive difference in what the seller expects and what the buyer is willing to pay, maybe help me understand, like, how have you helped either bridge that gap or maybe take the deal away and work with them over time to get them back to where they're excited about the deal again?
Yeah, and I'll give you a recent example. We were working with a seller of a home services company, and their EBITDA and overall company performance was declining in the most recent trailing 12 months. Unfortunately, a lot of buyers, that is the most important metric of the company. Whether it's fair and reasonable, that's still to be determined, but that is just the reality of what a lot of buyers are going to be looking for. How is the company performing in the last 12 months? I think the business declined from EBITDAs of 2 million, and it was roughly about one and change, so 1.1, 1.2 million in the most recent trailing 12 months. So, the sellers were frustrated by the perceived, significant decline in valuation, but at the same time, the prospective buyers had, a right to be concerned. So the question is, do you transact at the lower valuation? Do you wait? It's the dilemma a lot of deal makers face every day. In this case, they elected to put a pin in it, revisit it, in 6 months down the line, and through identifications in the sell side QOV around uh, expense pressures, et cetera, they were able to kind of flip that EBITDA back in a trailing, a positive direction. So while it wasn't the 2 million point, I think the last 3 or 4 months was around the 1.5 or 1.6 metric. So based on the narrative, and putting together a packet, buyers could reasonably predict that, hey, maybe this business is really a 2 million mark. And, the 1 million EBITDA was more of a blip.
That's fascinating. So taking advantage of the Q of E and then taking that raw material, that insight, and then turning it into a better valuation in not a very big, not a very long period of time.
That's right. And, you know, I certainly won't take credit for the implementation of it. I just provided the numbers to the owners and the investment bankers who had the patience and the foresight to pretty much mandate they pause going to market, see what they can do operationally, and then put the listing back up for sale.
Yeah. And did they end up going back with the same buyer, or did it end up going with a different buyer in the end?
So it ended up going with a different buyer who did express interest in that preliminary round. So while it wasn't the one who secured the LOI and then ended up walking away, it was the original buyer pool that ultimately transacted.
Oh, that's good. That's good.
Yeah.
So it wasn't like the time and effort was wasted in terms of getting ready for sale.
No, and that's one of the reasons why most sellers should conduct something like this, especially from an ROI perspective. If you do rough valuations on an EBITDA multiple plus or minus 500,000, that number becomes quite significant in
It
enterprise value.
does. It's especially at that level, right? The difference between a $1 million and a $2 million EBITDA is not twice the value. It can be significantly more than that just because it looks like it's a more stable, ongoing business.
That's right. And ultimately, I think it gave the seller confidence in the ability to make some of these operational changes that they may have known about, but until you see the dollars and cents of how this is impacting your end goal, which is to retire and sell your company, it didn't seem like reality until we finished that.
Yeah. So one of the things that I'm getting from this, Patrick, is that um, I have a hypothesis that anybody who is selling their business should make sure, like, first and foremost, that their accounting is solid. And once they feel like they've got their accounting solid, they should run a sell side QOV so that they can see what the how would I put it? Like an objective view of their accounting looks like, because it's going to give them the insight, the confidence to go and sell, and more leverage when they go through the sales process. So, am I thinking about that the right way?
You are, and I always use the words of, you need to fire yourself from being the finance and accounting function of your deal.
Hmm.
That speaks to the business owners who are looking to sell their company, but it also speaks to the investment bankers who are representing some of these companies. If bankers don't conduct a sell-side QOV or they don't mandate them to conduct one, they are signing themselves up to become the finance and accounting function of this deal. And that is not a fun position you want to be in.
Right. Now, I mean, there are challenges. I mean, larger companies, it's a lot easier to do that, right? But when you're a small company and you're going through maybe with an independent sponsor, that becomes more challenging. So, have you seen examples of where you can still get to that same outcome, maybe without the same level of investment?
Yeah, so depending on the type of business, if we think back to the home services, you could get a full soup to nuts sell side Q of E, which the folks at PwC and the larger firms would be happy to provide you for a six-figure fee. But there are many ways you can get a light third-party verification for a fraction of the cost. You know, Certainly any accounting firm like OAG's, there are dollars and cents that are real, and we like to, I certainly can understand some of the resistance to make that step. But if you take a look at valuations of companies sold compared to, folks that opt out of this, it seems like definitely something you want to be serious and think about before saying yes or no.
Yeah, because the downside of having it happen on the buy side and then dealing with the differences is that you've just you and I were talking before we got going, but you just lose all of your leverage in the deal when it comes back and it says, oh, your EBITDA is 75% of what you said it was, and actually you're declining. It looks like a bait and switch in terms of the deal that a buyer is going after.
That's right. And I like to use the word, you don't want a buy side due diligence team to dictate valuation. You want to be in a position where they need to articulate and provide analysis of why the valuation is, et cetera, but you want to start with your own work conducted. If you allow yourself for them to work off of reported numbers, your valuation is going to look very much different than if you conducted this light review. And the reason
Yeah.
why, I know this is I've worked with hundreds of buyers, and when we step into a target company and they don't prepare this, we have significant leverage over their deal team.
Yeah. Yeah, because you get to see it from both sides, so you know what it looks like on both sides. Yeah, okay. Yeah, to me, this is the big difference, Patrick, between thinking about this as preparing for sale and actually building something that somebody wants to buy. That feels like a different dynamic that you're going to market with.
That's right. Yeah, and it's something that folks don't often know about some of the differences, but through, some education can be very valuable, in my opinion.
Yeah. So any other examples of where somebody maybe has done it really well in your opinion, where you've taken them through that process and they're in a much stronger position as a result as they go through the deal?
Yes, but I think, I'd love to give you an example of a great, buy side Q of V I was working on, and we stepped into a very strong seller Q of V report. And
Mm,
it actually was eye-opening of, this is why you should do it. Um, it was conducted by a top 25 accounting firm, and effectively, we spent significant time combing through their increases to EBITDA. They effectively moved from a reported basis of 2 million, and they were showing a 3 million adjusted basis, which is, significant. And because they spent the time and resources and put together a very defendable one, effectively our report matched theirs. So, it wasn't the perfect outcome for the buyer team, but at the end of the day, they wanted to make sure the investment made sense from a dollars and cents standpoint. And it wasn't to maximize or decrease the purchase price. It was to get the answer of what is EBITDA. So it was
Yeah.
interesting to see that side.
No, that's interesting to get it to absolutely match. I mean, my experience is that buyers just want certainty. They want to know that what it is that they're buying is what they're buying. So that would give, I would think that would give them increased confidence that two different companies have come up with the same answer.
Yeah, and a lot of times deals that do transact have a lot of the human elements of deal making assured. The clarity of, can this business support the debt the buyer team is going to use to purchase it? Um, is the business a strong company that a new buyer team is walking into? Some of the intangibles like that give people confidence, and those deals end up actually transacting compared to having to win the negotiation war.
Right. And the whole idea that because that foundation is that much stronger, you've got a much greater likelihood that you can put debt on the deal and then deliver a better ROI and IRR for your for your equity investors. That seems like a big deal also on the buyer side.
That's right. And those are some of the best deals I've had the privilege working on.
Awesome. Okay, so we've talked about the kinds of work that you've done and what good looks like if you're trying to go through this process. I mean, maybe it's worth just taking a look back. I mean, you've done this over, you said over hundreds of deals. So if you were looking back today and you knew when you started everything that you knew today, what would you do differently as you think through how you've grown OAG, how you deal with these kinds of challenges?
Yeah, and this goes back to my roots as always having that entrepreneurial itch. I think the biggest thing in professional services, which is how can we create an environment that is as frictionless as possible for the folks we get to work with? Um, every meeting, every deal I work on, I like to acknowledge that their primary role is to run and continue operating the business that they're looking to sell. We are here to make their lives as frictionless as possible and give just assurances around the deal. We're not looking to be the hero of the story. We are certainly just the players on the field. So getting out of the way and sticking to our lane, I think, is something that professional services as a whole can do a little bit better of a job for and keep those end parties in mind.
Yeah, no, that's a great way of looking at it. Because when you're going through a deal, you're still trying to run the business, right? And all of these extra data requests can just take away that time from looking after customers and running operations. Um, Now, okay, we've looked back. Let's look forward. As you look at the future of deal making and the foundation of accounting and QOV, there's a lot of discussion these days on AI and the kinds of tools that you can bring to these problems. So, where do you see the future of this kind of work?
Yeah, it's a great question, and I don't think it would be of value if we didn't acknowledge the AI world we live in. It's funny because on one hand, I don't think AI is going to make as much of an impact in deal making as some people think. There is a difference between the ability of increasing the administrative side of deal making, but at the end of the day, the ability to transact and that small 5% of the project really moves the needle. And I'm not sure, AI is going to replace that anytime soon. At the same time, as we see, I see consolidation in the market with larger firms continuing to buy up smaller ones. So I think that continues going forward, just given there are a lot of firms and individuals in this space, but it's not as big as people see. So I think there's a lot more consolidation in the future.
Yeah, the thing that I wrestle with, Patrick, is that I think ultimately a deal is about confidence at the end of the day, and that confidence comes through relying on people with judgment. And so, at some level, the discussion is not what does your spreadsheet say? It's What does Patrick and OAG say, given their experience and their deep expertise? I don't think that AI gets rid of that.
I tend to agree. I think there are a lot of ways you can leverage AI to decrease the project costs, especially in, putting together data books or putting together documents. But eventually you need the trained eye to give you the reassurances, which is why entrepreneurs and buyer teams will engage with us because they need that second, and third party diligence to give them assurances around their investment.
Yeah, that's right. Because ultimately, they're going to look at you and they're going to say, "Do you stand behind this analysis?" And I just don't think that ChatGPT is going to stand behind it the same way that you do.
That's right. And, never say never, but for now, I think that's where we stand on the whole AI accounting bubble.
That's fantastic. Well, Patrick, I really want to say thank you for joining me on the Mid-Market Edge. This was a fascinating conversation about how sellers can be more ready to go through a frictionless, you use that a number of times. I love that thought process. Go through a frictionless sales cycle and get the kind of valuation that they're looking for. Thank you very much for your time today.
Yeah, absolutely. I really appreciate it.
Cheers.
Cheers.
Thanks for tuning in to the Mid-Market Edge podcast. For more information, visit the Mid-Market Edge website at midmarketedge.com. Details are in the show notes. Remember to subscribe and like the show so you'll never miss an episode. And until next time, keep building your edge in the mid-market.